Hello folks, Charlie Gipple here with CG Financial Group. This video is going to be fun. This video, we are going to get in some cool stuff here that if you are not familiar with cash value life insurance, if you're not familiar with the banking concepts, we're going to get into this. Now, here's my disclaimer. If you're looking for drama, if you're looking for Charlie to say this sucks or this is absolutely great, I'm not going to go there. This video is what it is. It's one of those it is what it is videos in that it's not meant to be positive. It's not meant to be negative. I just know these banking concepts when it comes to IUL as well as whole life insurance. There are a lot of misperceptions out there. You know, I get this every single week. Hey, Charlie, I have this client who looks like this, and this. Don't really need life insurance. Really, what's their credit score? Oh, they have an 800 credit score. But I think that it may make sense to put them into, you know, an XYZ life insurance policy and use that banking concept because of this, and this. No. And I know that sounds like a very general answer. Technically, I drill in a little deeper than that before I say no, the concept's not for them. But my point is there's a lot to learn about this concept because many times it can feel like it's a magical money-making machine, right? A lot like IUL. You know that I love IUL, but I can make an illustration today that takes a crappy product and make it look like it's an absolutely magnificent money-making machine, magical money-making machine even, not just money-making machine, a magical money-making machine. So what I want to do is I want to talk about these banking concepts. And by the way, you may be thinking, what the heck is Charlie talking about? He already lost me. What are these banking concepts? The banking concepts are the notion of, okay, typically in our lives, outside of the life insurance world, here is kind of how we work. We go over and we may invest some money with XYZ brokerage company. We may. A lot of us do, but some of us do not, which is one, gets to the heart of something I'm going to talk about here. The whole buy term and invest the difference, by the way, well, heavy on the buy term usually, but light on the invest the difference, right? Anyway, I digress. We invest over here. We may go to Wells Fargo and get a loan for whatever, $5,000 in a given year for whatever reason. The notion of these banking concepts is what if we have a turnkey package? What if we have a cash value life insurance policy that builds cash value while at the same time you have the ability to take loans against that cash value to finance your purchases, right? And by the way, notice I said loans against the cash value. Why do I use my words that intentionally? Because it is not loans from the policy. Rather, it is loans against the policy from the insurance company. I'm going to explain what I just meant here before I get started. By the way, you see this, that's kind of out of the corner of my eye here, and I just realized this. I should tell you what the Secure Act thing means. That's my flip chart. On Thursday, we're doing a video conference, not a webinar, not death by a million slides, like I know that you find folks just absolutely love. Doing a video conference where it's just me and my trusty flip chart talking about 7 different points around the Secure Act. If you want to join us for the Secure Act conversation on Thursday, and it is a conversation, I'm going to ask you if you have any questions, ask me, and maybe a little bit of back and forth. We'll see, depending on the audience size. Anyway, that's on Thursday at 11 o'clock Central Time. So that's that. I was going to mention something else, but damn it, I forgot. Anyway, IUL versus whole life. Yes, this is what I was going to mention. IUL versus whole life insurance. I get this every other day or so. Which one is better, IUL or whole life insurance? Well, which one is better, a Chevy or a Ford, right? Which one is better, a stock or a bond? It depends on the person and what it is they're trying to achieve. You can also send me an email and I'll send you my video on IUL versus whole life insurance. Which one is better? Spoiler alert, I've tried to find the answer of which one is absolutely magnificent, which one stinks, and I don't have an answer to it. There is not one definitive answer, and for those of you that know these products, you know that it's not just me trying to be neutral, trying to appease the masses. No, there is not one that is better. It truly does depend on the client's situation because I wanted a definitive answer. There is no definitive answer to that. I can tell you when to use one over the other, but there is no answer on which one is better. So as we talk about life insurance and these banking concepts, I want to start out by this, by explaining really how a life insurance policy works when there's a loan taken against it. If you look at a ledger on an IUL ledger, let's say, or a column, look at a ledger on an IUL illustration, you will find that there are three primary columns, right? There's a cash value column, there's a surrender value column, there's a death benefit column. Those are the three primary columns. The cash value is self-explanatory, right? The client puts money in, that cash value doesn't have surrender charges embedded in it or anything like it. It just shows how the client's money is growing, based off of how the index does or how the interest rate does if we're talking a whole life policy, minus the cost of insurance charges and all that. The second column is the cash surrender value. The cash surrender value is exactly the same as the cash value except for two different things, right? The first thing is, and I'm going to show this to you visually here in a bit, so don't get confused. Well, you may be confused, but I'll explain it here in a bit. The cash surrender value column is the same as the cash value column, except for the first area, which is in surrender period. Surrender charges are reflected in the cash surrender value side of the ledger. But the second thing is when you take loans against the policy, that cash surrender value is reduced as well to where the cash value is not reduced. I'll explain why that is here in a bit. But the third column, of course, is the death benefit column. One of the most important columns because we're buying life insurance, right? That's the death benefit column, which reduces when there are loans taken against the policy. Now, why are these values reduced, but yet the cash value is not reduced? So again, three different values: cash value, surrender value, and the death benefit. And I'm not getting technical just to get technical here. This is the very core of understanding how these life insurance policies work when there are loans taken against them. You are not taking loans from them, you are taking loans against them. What do I mean by that? So think of these life insurance policies as a completely separate entity from the financial institution that issues them, right? So you have XYZ Insurance Company, you have the life insurance policy. Now, let's say you have $200,000 in value from the life insurance policy, but you're retiring, you're 65 years old, you want to take $5,000 a year out for the rest of your life. You want loans of that value, tax-free loans, because loans are tax-free, right? When was the last time you went to Wells Fargo to get a loan and you got a 1099 on that loan? You don't. Loans are tax-free. So you go to the insurance carrier, has nothing to do with the policy. You go to the insurance carrier and you get that $5,000 loan. The insurance company, no hassle, sends you that loan amount. And it's a pretty secure loan. Why is it a secure loan? Because once upon a time, that insurance company said, okay, if we're going to loan as a financial institution, which an insurance company is, if we're going to loan consumers money, how do we know, first of all, that should that consumer pass away, for instance, that we're going to get our principal amount back plus the interest that that person owes us? Well, what does that insurance company do? The insurance company, they put a lien against the death benefit. That way, should a person have an outstanding loan against the policy, when that person passes away, the death benefit pays for the loaned amount that is owed to the insurance carrier, right? That is why that death benefit column, the third column, that's why it reduces by the amount of principal plus interest, right, on the loan. But the insurance carrier once upon a time asked a second question. Now, but what if the client surrenders the policy? What if the client surrenders the policy and just goes off into the sunset with his $5,000 plus interest? How do we guarantee ourselves that we get the amount of money that he owes us back without sending somebody after him to bust his kneecaps or something like that? How does the insurance company do that? They put a lien against the surrender value, right? Again, the same lien as was against the death benefit. That is, the principal amount of the loan plus interest is reduced from that surrender value column. Did we take 1 penny out of the insurance policy, however? Is that cash value reducing at all? Did we have anything to do with the life insurance policy when we went to get a loan? We didn't know because we went to the insurance company and said, hey, we want a loan. And the insurance company says, well, okay, we'll put a lien against the death benefit as well as the surrender value. We did not take 1 penny out of that policy. Therefore, that cash value is still continuing to grow. The surrender value is being reduced because of the lien amount. The death benefit, the net death benefit that is being reduced. Gross death benefit doesn't include loans. Net death benefit has loans reducing it. I bring that up because when you think of loans against a policy, think of it as two separate entities, the policy and the life insurance company, right? You're going to the life insurance company for the loan. Now, that is the primer. Completely erase everything about life insurance from your head, at least for the next 5 minutes. I'm going to draw a corollary here. I'm going to talk about these banking concepts through the lens of explaining really how these life insurance policies work on a spreadsheet that we're going to fade over into here in a bit. How do these life insurance policies work, and why they are not just magical, mysterious, money multiplying machines like one may think that they are. Do they have huge benefits? Absolutely. The benefits far outweigh any negatives that these policies have, at least for most consumers, right? And I'm going to talk about those here in a bit. So completely forget life insurance. Let's say we go about our life in a normal way, in a non-life insurance world, right? Over here on the left-hand side, I say, okay, so here we're going to invest. We're going to go to a brokerage firm. We're going to put in, say, $10,000 per year. And let's say, hypothetically, we're able to get 5% on that, what's ultimately $40,000, right? Well, then our $40,000 in cost basis, that grows to $60,647, right? Very simple. Well, we also go about life, most of us do, in that we take on a little bit of debt. We need loans from Wells Fargo, Bank of America, whoever. In this case, we go to the bank, say 5 years into this scenario, this snapshot here, 5 years into this snapshot, we go to, and by the way, these numbers are completely random. Literally, I put this spreadsheet together within about 10 minutes just to demonstrate the workings of a life insurance policy, but we're not talking about life insurance yet. So $5,000, that's the first year loan here. The second year loan is another $5,000, another $5,000. So we're up to $15,000 loan principal balance, and then 5% on top of that. Long story short, here is the total balance that has accumulated over this 6-year period of time, right? $35,710. So you have your investments over here that have grown by 5% per year. Yeah, you're doing pretty good. Why? Because you went through the pain of putting in $40,000. So you have $60,647 at the end. Over here, you took out $5,000, less of amount and less time to have interest assessed against it. So as you can see here, $35,710 is the balance that is due on the loan. Now, the most important value to you and me in our financial lives, at least on this spreadsheet, is this value over here, our net worth. Our net worth is basically an indicator for how wealthy we are, right? Our net worth. That is, I wouldn't say it's the amount of purchasing power. I mean, after all, I know banks that would loan people money if they had negative net worth, but this is effectively how well you are doing financially. The definition of this, as you can see up here by the formula, the definition of this over here is this value minus that value. Again, assets minus liabilities equals net worth. You don't have to be a CPA to know that's how net worth is calculated. This minus this is your net worth. And of course, I'm just assuming these two things, this investment and this debt in isolation without taking anything else into consideration, their home and all that other stuff. Why? Because I want to draw a corollary here in a bit. What is most important is this net worth column here, right? Because that is the amount that really determines how financially successful you are. Kind of in a simplified way, the less that this is, the less purchasing power that you're going to have in life, right? For the most part, if you have negative net worth, many times you're not as healthy as somebody who has positive net worth. Many times, not always, but I think you get what I'm saying. If you have enough assets that can be turned into cash to far offset the liabilities that you have, to pay off all your liabilities and all that stuff and still have some money left over, well, that positive net worth, you're doing pretty darn good, right? What I just explained here with these three values, the investment balance, the total loan balance, and then the total loan balance subtracted from the investment balance to equal the net worth, what I just explained there was a simplified version of how the cash surrender value in a life insurance policy is calculated. I'll repeat that. What I just explained here was a simplified version. Simplified as in no surrender charge is assumed, during the first 10 years or 12 years or whatever. No cost of insurance charges, no premium loads, no per thousand charges, none of that. This is a simplified way that we arrive at, that insurance companies arrive at the cash surrender value. For instance, what I will do is I will take this spreadsheet over here, all this stuff, and I will just, I basically cut and pasted it, except I relabeled the columns, right? The exact same numbers here, your $10,000 going into, say, an IUL policy, for instance, right? That IUL policy, let's say that in our example, it grows by 5% per year. You stop paying premiums at the end of the fourth year. And I don't want to hear any folks, in the comments or whatever say, oh, that's not fair. You only assume 10-year period of time, this and that. I'm not communicating. The concept has nothing to do with the amount of time, the amount of leverage, the massive amount of growth that one can get with the cash value. The end concept here is really the construct, the logistics of how these policies work. So don't worry about the simplified example here. So $10,000 premium going in, growing by 5% per year, hypothetically. But then that consumer in a certain year maybe wants to take a loan against the policy, not from the policy. Take a loan from the insurance company, not from the policy. That insurance company then, cuts a check to the client each year. But because with our life insurance policies, which this is one of the benefits of these banking concepts and life insurance for that matter, is, and this actually isn't used all the time in the banking concepts to where, I'm about to say, well, they don't have to pay back the interest in that. Actually, many of the banking concepts say, no, if the bank, hold yourself accountable, pay the loan back to the insurance company, because then that will give your surrender value, a better ability to increase, which I'll show you here in a bit. So what we have here is the exact same thing as what I just talked about, except this is all in one package here, right? You have the cash value that's growing. You have the total loan balance that is growing, which was disconnected, in our previous investment example and Wells Fargo example. Now it's under one roof here. But what does this minus this equal in insurance policy terminology? That equals the surrender value, right? What I just explained, what I am saying is these life insurance policies, and this may help or hurt your cause. It may hurt your cause for me to explain this if you've been using hyperbolic language, as in these are money multiplier products and all that stuff. It may help your cause if clients say, that's too good to be true. Well, no, it's not too good to be true, because here is exactly how it works. It's possible. It's 100% possible. And I just explained how it's possible here. The insurance company is quite simply doing what Wells Fargo otherwise would do, except the insurance company is able to do it a lot easier with a lot less hassle to you, the consumer. Why? Because that insurance company is guaranteed that they will get their money back. How is that? Because they put a lien against that value, a lien against the death benefit, which did not exist in our previous example, which means that they always get paid back their money, right? And that's a big benefit. No loan docs, no credit reports, none of that crap that you have to do when you get a loan from the insurance company. So that is one of the positives. Again, the goal of this talk is to teach you how this stuff works. It's not about the positives. It's not about the negatives. It's about all of that stuff, right? And I report, you decide what your opinion is there. So for the clients that think it's too good to be true, maybe me saying that this is not a magical money-making machine and explaining that this minus this equaling the surrender value is basically the same as what we talked about, as if you use two different entities to do this and this, right? It's not magical, Mrs. Client, and therefore it's possible. Not only is it possible, a lot of clients have made a lot of money with this design and have gotten a lot of income, whether in retirement, whether it's to finance a car or what have you, with this design. So you can see here the death benefit, which is the most important part of life insurance, right? Because the client's purchasing life insurance. And this is the compliance part of me coming out. If consumers don't need this death benefit here, you're going to have a tough time explaining to the regulators why you sold them life insurance, because technically over here, in a less simplified example between here and there, you're going to have cost of insurance charges deducted, right? Which I did not do here. Between here and there, cost of insurance charges, premium loads, all that stuff deducted, which I technically did not do here. And that is to pay for this, and this. But anyway, over the period of 10 years here, you can see that it reduced to about $65,000. Why is that? How I kind of started the conversation, because that loan balance is deducted from the net death benefit because of that lien that is against the policy. Now you may be saying, well, but Charlie, and this is where people get their minds kind of tangled up. It's very easy to get your brain cells kind of in a knot when you think of this stuff. But Charlie, isn't that, you hear this, I've heard this a lot. Well, you can save your clients massive amounts of interest by using this banking concept. They're not paying any interest with this banking concept. Technically, that is true. The client, while they're alive, is not paying any interest if they just let that balance grow, right? Let that balance grow, and then they pass away. And the death benefit over here, that $65,000, which the gross death benefit is actually $100,000, right? But that $35,000 went to pay off the debt. Well, technically, the client didn't pay a penny of that interest. But did that mean that the principal balance plus interest did not have any impact on that client? No, it does not mean that, because this is the value. Remember why I said that the net worth, which is now surrender value, that the net worth is so important to me and you? I mentioned that for a reason, a lot like how the surrender value is so important to me and you, because when this surrender value, which is reduced as a result of those loans and loan interest is being taken out, when that surrender value hits zero, heaven forbid should it ever hit zero, like when you're age 85 years of age, for instance, and there was a miscalculation on how much income you could take against the policy, loans from the insurance company against the policy, and all of a sudden your balance hit zero, well, you have a policy that's lapsing. Because this surrender value hits zero at age 85, heaven forbid should that happen, I would argue that this value is very important. And because this value is very important, then it's very important that we not play games with words when we talk about, well, they're not paying a penny of interest. Well, technically, during the client's life, they're not paying a penny of interest, but the amount that we are basing their retirement income on is reduced by that interest plus the principal amount, right? So my point is that makes sense. I've also heard, well, the magic with life insurance is that it's the volume of interest. For instance, we assume the same interest rate over here as what we did here. And by the way, with IUL, there's a big possibility that the interest rate charged on this side is a heck of a lot, less, I'll put it that way, than the interest rate that client earns in that index. Non-direct recognition IUL policies, it can be the same thing, right? But that does not mean that basically the insurance company is paying the consumer to take a loan, quote unquote, from the policy, right? No, the loan amount does affect the consumer, whether this loan interest is 1% or 7%, whether the policy is growing by 3% or whether it's growing by 10%. This loan amount does affect the consumers because that reduces their surrender value, right? And that surrender value is at least when it comes to income and tapping the policy for loans, or tapping the insurance company for loans in which the insurance company assesses a lien against the surrender value. That's very important, the surrender value column, right? But anyway, what I've heard a lot is, wow, $40,000 going into it. And then it's grown, the value has grown over the years to $60,000. So that interest, even though it's the same interest rate over here as what we're assessing against the loan over here, well, it's the volume of interest that matters, which is what makes these policies so great. The volume of interest, meaning that you're getting, even though it's the exact same interest rate, you are actually earning, what is that? That's $1,200 more than what is being charged to you. Well, yeah, but but the bottom line is for every dollar of the $30,000 you took out in loans, the bottom line is the amount of collateralization over here That's only being given a 5% interest rate. So it's a wash in that example, right? And the bottom line is the whole volume of interest argument, it doesn't really work for me because there was a cost to entry with that volume argument, right? And that cost to entry was, as well, you put in more money, as well as more time, by the way. You put in more money, or you put in money, period, and then the amount of time that goes by gets that balance to where it's high enough to where your volume of interest outweighs that over there. I guess the big point I would make with the volume of interest thing is whether it's a life insurance policy or anything else, and this is the main point I would say to this, whether it's a life insurance policy or anything else, the investment thing over here, this is a corollary that I drew for a purpose, right? Whether it's an investment that you have over here and a loan taken from Wells Fargo, or all within the life insurance policy and the loan coming against the life insurance policy, it can be done anywhere else, right? So that's not anything that's really specific to a life insurance policy. Now, some of the benefits of the banking concepts, and of course IUL, which I love, and whole life insurance, which I love, is this. You and I both know, go back to our investment and Wells Fargo example. You and I both know that this over here, think of buy term and invest the difference. Does that happen all the time? Many times it's heavy on the buy term, but light on the invest the difference, right? And by the way, if you don't invest this over here to get to say 60,000 over here, well, then that means that your net worth is going to be negative, right? Because you're reducing. Actually, as a matter of fact, you're probably not going to be able to get that loan because this didn't take place in the first place, right? So my first positive point about the notion of life insurance for banking. Actually, I have three right off the bat that I can think of. One is the death benefit. With what I just explained over there, you don't get a death benefit like you do with a life insurance policy, albeit you have to pay cost of insurance charges all that. The second thing is very, 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 very important. These values that are coming out, these values that you're taking in loans, tax-free, right? Tax-free, 100% tax-free at that point in time when you take loans out, assuming the policy is not a modified endowment contract and it's never taxed, assuming the policy does not lapse, right? Well, one can say, but these loans from Wells Fargo were tax-free as well. Well, yeah, I get it. Over here on the life insurance side, another thing is forced savings, right? Mrs. Client. $100,000, a whole life insurance policy. Your premium going into the policy is this. And by the way, not only is the value of your life insurance policy by putting in, say, $10,000 in premium, just an example, that's way high of a premium, but you get it. Not only do you have the benefit of the death benefit, but should you ever want to take a loan against the policy, no hassles, no ifs, ands, or buts. The insurance company is going to give you that loan amount because it's a secure loan. You don't have to jump through the hoops that say Wells Fargo is going to make you jump through, or Bank of America, or any bank out there. It's a built-in it's kind of a built-in financial complex, right? To where you have the ability to grow the cash value, the quote-unquote investment side, while at the same time you have the ability to have a bank within your life insurance policy. There are a lot of reasons and about 30 other reasons why the banking concept is good, but it is not good because it just magically multiplies the client's money like nothing else will do because of the volume of money concept. Well, whether it's this tab, the life insurance tab, or the investment tab, the volume of interest versus the volume of interest earned versus the volume of interest paid, it's the same, right? Now, another thing, and I'm not going to go into various products, another thing is many times the loan interest is favorable. 5% rates, 4.5% rates. Many times that loan interest is locked in for the life of the policy, right? And if we're talking a participating loan on IUL, many times that loan interest that you're paying is less than maybe what it's earning, what the cash value side is earning in the index there. So obviously that makes your net worth or the surrender value go up when this is performing much better than this, right? Then that makes that higher. What are some other ones here? Again, no hassle. Now, I have had a couple of folks come to me and say, hey, Charlie, I have this consumer. He's always going to the bank. You know, he pays his debt on time and all that stuff. Maybe this banking concept should be good for him or her. Okay, does he need life insurance? No, doesn't need life insurance. But I think the banking concept, you know, using the life insurance policy as a conduit for getting finances is good. Okay, what's his credit score? His credit score is 800. Well, okay, what's his investment mindset? Well, he invests a lot, and you know, he's a younger guy and invests in the market. There are flaws with everything that I just said, at least if that agent was going to recommend a banking concept with life insurance. For instance, if one thinks that versus a cash value growth on a life insurance side, if one thinks that they otherwise could beat that, well, then maybe keeping it separated out makes sense. Investments and then going to Wells Fargo. If the person has a high credit score, then maybe a 5% interest, like me, I have like an 820 credit score, right? There's not a bank on earth that will not give me very, very, very favorable loan rates. Certainly, I would hope. I haven't bought a car recently, but I would hope that a car it would be a heck of a lot less than even a 4% rate, right? Well, then does this banking concept make sense? And most of that comes down to, does the client need life insurance? Okay, if the client needs life insurance, what kind of life insurance is it that the client's looking for? Is it kind of the Swiss Army knife approach? The convenience, by the way, there's also convenience with this. Maybe somebody that's a multi-gazillionaire just wants the convenience of, yeah, I don't want to be hassled with the loan docs and all that. I just want to send a loan request to the insurance company and have that. I don't care if I pay more interest. Well, that's fine. Maybe that consumer says, yeah, the stock market, all that stuff, I'm doing good over there, but I want kind of a fixed portion of my I want to use cash value life insurance, like whole life insurance is just kind of the safe part of my portfolio. Well, then, yeah, then these concepts are absolutely great, but these concepts are not great because of the fact that they magically multiply the client's money beyond what that client would be able to do with getting a loan from Wells Fargo and going over to XYZ Bank or going over to XYZ brokerage firm and investing their money. That was longer than what I thought it would be, but I hope it made sense. A lot of folks, when I present this face to face, there are a lot of alarm bells that go off and they ask me questions. I don't think that my conversation dilutes the notion of these banking concepts, and that's not the intent today. The intent is to demystify it and say, forget the banking concept. It's how these life insurance policies work. They are not magic, and Mrs. Client, it is possible. It is not pie in the sky. If you have questions, give me a call. My number is 515-986-3065. Again, Charlie Gipple here with CG Financial Group. Have a good day.